Good evening, everyone. Time for another silver update. This is the 8-hour chart of gold. And as you know, we had a nice little rally this morning with the Greek news. I'm going to cover that later. So we got this nice little rally up to about 1755. Now the next point we need to penetrate here is going to be about 1765, 1762 or so. We need to get through that old high, and then we're going to be challenging 1800. Now you can see from this chart that actually the time period that we spent above about this level here, really above 1800, was really a short space of time, really just parts of August and parts of September. And that's the only other time that we're higher than these prices. So we're kind of strengthening here in a slow bull market. A move up above here, of course, is going to be challenging this zone of increased volatility. You can see the great volatility here. This move right here in a very, very short space of time came down from about above 1900 to near 1700, back above 1900, so 200-point swings. You can see we're not anywhere near that level of volatility, so if we move into the next level and start to have that level of volatility, you can see you can move $200 in a very short space. So gold is shaping up to be very bullish. Silver had a very excellent pop today as well. You can see we got to about 34.40 or so, and then we fell back a little bit. Our resistance is going to be about 34.50 to get past this high, and then we've got $36 waiting up above. That's going to be the next big point. We want to see if we get past this old high and head into the 36 level. We've got a lot of this churning and resistance from the past that we need to get through. So silver has quite a bit more overhead resistance, this whole area here as well. A lot more overhead resistance to get through than gold does. The other chart, of course, is going to be the oil, and you remember that I pointed out on the daily that we had that trend line coming down. And actually I have to go out one farther. Was it the weekly I was on? So we had that trend line coming down, and we're just in the area of penetrating that. And then we zoomed up into the 5-minute view, and you can see that long-term trend line, yesterday we jumped up to it and touched it and then kind of stayed below it, and today we had a breakout through that line. So that line seems to be a very valid line. Now if we look at the long term on the oil chart, like I pointed out, we have this massive pennant forming here. And if we break through this price of around 115, there really isn't that much overhead. You can see if we draw that line, we'll draw it back from here so you can see. Draw it all the way out. And you can see that there's really just this very small area where we traded at that price. So that doesn't present a lot of resistance. It's quite possible that we could move through this area very quickly and go into new highs. If we did something like that, that would probably portend $5 to even maybe $6 a gallon gas, and that's going to be getting to the point where it really bites, because that's going to affect profitability of a lot of industries. It's going to affect people in their pocketbook, and eventually a high enough oil price is probably going to induce a recession. So we'll wait and see what that does. And of course there's always the worry about the Middle East situation getting out of hand, and that could have a very rapid impact on the price of oil. Now I want to jump over to the main story of the day, and that is going to be Greece. As you know, Greece signed what I described in my blog today as the deal with the devil. Basically, Greece agreed to a $176 billion bailout. This is an article on Zero Hedge by Mark Grant, and he doesn't really pull any punches here. His description of this bailout is pretty much that it is a bailout of the banks and the European Union specifically. He says the structure of the deal. Sorry. I was trying to get a little bit closer there. The structure of the deal puts the IMF, EU, ECB clearly in control of the finances of Greece, so that they have replaced some sort of czar with the bureaucrats of the Troika, and the country no longer will control its own finances as they traded away their sovereignty for cash. In fact, an escrow account will be set up for Greece, which will be controlled by the Troika, and Greece is being forced to change their constitution, pledging to pay their creditors before providing any money for the country. A quick study of the math reveals that Greece will get about 19 cents on the dollar, and the rest of the money is the sovereign nations of Europe paying back their banks with the money they have supposedly lent to Greece. Greece is now nothing more than a conduit for the nations of Europe to pay back their own financial institutions. So this is really, in my opinion, a tragedy for Greece. Now, as you know, I've criticized Greece in the past for their type of system that they have, but I've said consistently that it's my opinion that Greece should completely default on the debt. They should 100% walk away from the debt and just tell all those people to just go away and go back to the drachma. And I think it would be a very good thing if Greece adopted a very open market, low tax economy, encouraged a lot of tourism, which is what they're very well known for and very equipped to do. And they could have a booming economy, in my opinion, a booming economy in a very short amount of time, because a very, very reduced drachma would be able to allow all the Europeans to come in and trade their euros for the drachma, or Americans, etc., could vacation in Greece at very reasonable prices, and I think the Greek economy would revive very quickly. So I think that Greece made a terrible mistake. Well, I'm not saying the people of Greece, of course. I don't believe the people of Greece are responsible for this. But the politicians of Greece made a terrible mistake. I believe they betrayed their people when they did this. Now, I wanted to juxtapose this to another situation that happened a number of years ago. I don't know if you remember, but this picture kind of tells the story. This is in Iceland, and this was on the eve of a very important vote where the president of Iceland was going to sign off on a bill that would back the Iceland bank to the tune of $5 billion, basically a bailout for Iceland, but in reality what it was a bailout for the foreign creditors. And you can see that the people pretty much decided what they thought about that and surrounded the president's house with torches. And of course, you know the story. I'm going to read a little bit of it to you. The torches come out in Iceland. Protest breaks out in Iceland over bank bailouts. $5 billion almost seems like an insignificant amount these days, but to a tiny country like Iceland, it's a ton. 13,000 euros per capita to be exact. Icelandic lawmakers have proposed the public cough up $5 billion to pay back England and Holland to make up for the failed bank Iceland. English and Dutch depositors who lost money when the banks failed, and their respective governments compensated those individuals. So the individuals were already made whole. Now it's the governments that want the money. Iceland originally agreed to pay those governments back, but the public is strongly opposed to the bailout. Why should the country as a whole pay for the recklessness of a few? You could say this is a recurring theme worldwide. Due to extreme backlash, the president of Iceland has so far refused to sign the bailout bill into law. The UK and Netherlands aren't happy, but the already hurting Icelandic public are breathing a sigh of relief. The pictures below are from one of the protests that led the president to veto the bill. Remember all that talk about torches and pitchforks? Well, Iceland went ahead and broke out the torches. Okay, so they're flares, technically. More on the political situation from Der Spiegel, and you can read that. I'll link the story. So the Icelandic people were very clear. They were not willing to trade their sovereignty, and they were not willing to bail out the banks. It was their opinion that the banks had lost the money through incompetence and criminality, and they weren't going to pay for it. And the people who loaned the banks the money were just going to have to eat the losses. So I wanted to take you over to an article that appeared just recently, and this is about what's happened to Iceland since. Icelandic economy bounces back from the brink. Iceland's economy suffered a meltdown in 2008 with its banks defaulting on $85 billion. In 2009, its citizens took to the streets and demanded action from the government against those they saw as responsible for the crisis. The government responded, putting people before markets, and now Iceland's economy is outgrowing the Euro one and, on average, the developed world. Bloomberg reported that it was determined in 2008 that the banks could not be saved. The government intervened. It ring-fenced domestic accounts and shut out international creditors. Iceland's central bank prevented the sell-off of krona through capital controls, and new banks were created that were controlled by the state. Then the government and the state-controlled banks agreed that amounts in excess of 110% of home values would be forgiven on mortgages. The country's Supreme Court also ruled in 2010 that debts indexed to foreign currencies were illegal, which saved households from having to cover losses resulting from drops in the value of the krona. An Icelandic Financial Services Association reported, cited by Bloomberg, pointed out that the country's banks have forgiven loans amounting to 13% of Iceland's GDP. That lessened the debt load of the population. In addition, the government is investigating and prosecuting numerous prominent figures from the meltdown. Currently, more than 200 face criminal charges, and a special prosecutor has said as many as 90 may be indicted. Lars Christensen, chief emerging market economist at Danske Bank in Copenhagen, was quoted saying, "You could safely say that Iceland holds the world record in household debt relief. Iceland followed the textbook example of what is required in a crisis. Any economist would agree with that." The result, according to the Organization for Economic Cooperation and Development, Iceland's economy is in line to expand 2.4% both this year and next, after growth of 2.9% last year, and in the wake of shrinkage of 6.7% in 2009. In contrast, the OECD estimated in November that the euro area will expand only by 0.2% and the OECD area by 1.6% in 2012. Not only that, but the cost to insure against an Icelandic default is about the same as to insure against a credit event in Belgium. And Icelanders are no longer eager to join the Eurozone. Most would rather stay solo. Housing as an element of the consumer price index is only down about 3% from what it was in September 2008, just prior to the collapse. Fitch Ratings just last week also conceded that Iceland's approach has worked, raising the country's rating to investment grade with a stable outlook. At the time, it said that Iceland's unorthodox crisis policy response has succeeded. Thorfinn Mathiasson, an economics professor at the University of Iceland in Reykjavik, was quoted saying, "The lesson to be learned from Iceland's crisis is that if other countries think it's necessary to write down debts, they should look at how successful the 110% agreement was here. It's the broadest agreement that's been undertaken." According to Christensen at Danske Bank, the bottom line is that if households are insolvent, then the banks just have to go along with it, regardless of the interest of the banks. So, there's your choices. These are the directions you can go. You can go the direction that Iceland went, when they basically told the foreign creditors and the bankers and the rest of them to go jump in a lake. Or you can do what Greece just did, which is basically trade your sovereignty for more money, which of course is just going to be an increasing debt burden that you can't carry, and it's going to result in more austerity, and of course it's just going to result in another bailout having to occur further down the line, because so much of the GDP is going to have to be dedicated to servicing that debt. So Greece definitely went the wrong way today. They should have told the bankers where to go and just simply defaulted, left the euro, in my opinion, and gone back to the drachma. They would probably recover a lot faster. But they didn't do that, so that was very bullish for gold, very bullish for oil, and very bullish for silver. We're looking for a breakout to new highs, at least looking short-term new highs for 36 level. And if we can get to that, hopefully we can continue up and move towards the old highs. And we'll talk to you next time.